Hey, so real quick before we get into this, if you have somewhere around $750,000 saved up for retirement, or honestly, even if you're anywhere close to that number, you need to stop whatever you're doing right now and watch this entire video. Because what I'm about to walk you through today is something that most financial advisors aren't talking about loud enough, and the IRS is absolutely counting on the fact that you don't know about it. I'm calling it the Silent RMD Bomb, and it is set to go off in 2026 in a way that could cost retirees tens of thousands of dollars, quietly, legally, and without a single warning letter from anyone. I'm Jason. Welcome back to Jason Retires. And if you're new here, this channel is all about helping everyday Americans navigate retirement with real information, no fluff, and no confusing Wall Street jargon. We talk about the stuff that actually matters when you're living on a fixed income or getting close to it. So if that sounds like your kind of content, hit that subscribe button right now, because I drop videos like this every single week and you do not want to miss what's coming. Now let's get into it, because this is genuinely one of the most important retirement topics of 2025 heading into 2026. And yet when I bring it up to people at seminars or in the comment section, the reaction I get most often is either confusion or silence. And that silence is exactly the problem. So let me set the scene for you. You've done everything right. You spent decades working hard, contributing to your 401k, maybe a traditional IRA, maybe both. You lived within your means, you saved diligently, and now you've got somewhere in the neighborhood of $750,000 sitting in tax-deferred retirement accounts. That's a genuinely impressive number. You should feel proud of that. But here's the thing that nobody told you clearly enough when you were building that nest egg. Every single dollar sitting in those tax-deferred accounts has never been taxed, and the IRS has been patient. They've been waiting, and starting in 2026, their patience is going to run out in a very specific and very expensive way for a lot of retirees. Let me explain what an RMD actually is for anyone who might need a quick refresher, because understanding the foundation here is critical before we get to the bomb itself. RMD stands for Required Minimum Distribution. It's the amount of money that the federal government legally requires you to withdraw from your traditional IRA, your 401k, your 403b, and most other tax-deferred retirement accounts once you hit a certain age. As of right now, that age is 73, thanks to the Secure 2.0 Act that was passed in late 2022, and in 2033, it's scheduled to go up to 75. So on the surface, it sounds like Congress is being generous, right? They're giving you more time to let your money grow. But here's where the story starts to get uncomfortable. The way RMDs are calculated is based on your account balance and something called the IRS Uniform Lifetime Table, which basically determines how much you're required to pull out each year based on your age and your projected life expectancy. And the older you get, the larger the percentage you're required to withdraw. So if you've got $750,000 sitting in your traditional IRA at age 73, you're looking at an RMD of roughly $28,000 to $30,000 in that first year alone. That sounds manageable on its own. But here's what makes this a bomb instead of just an inconvenience. That $28,000 or $30,000 doesn't exist in a vacuum. It gets added to whatever other income you have, your Social Security benefits, any pension income, any part-time work, any investment dividends. And when all of that stacks up together, it can suddenly push you into a higher tax bracket than you expected. It can trigger something called IRMAA, which stands for Income-Related Monthly Adjustment Amount, and that's the surcharge that Medicare adds to your Part B and Part D premiums when your income crosses certain thresholds. And it can cause more of your Social Security benefits to become taxable than you ever anticipated. Now you might be thinking, okay, Jason, this has always been how RMDs work. What's different about 2026? And that's exactly the right question. That's where the bomb part comes in. Here's what's happening in 2026 that most people don't know about. The Tax Cuts and Jobs Act of 2017 lowered individual income tax rates significantly. It expanded the standard deduction. It changed the bracket thresholds, and those changes have been in effect since 2018. But, and this is the big but, those changes were never made permanent. They included a sunset provision, which means they are scheduled to automatically expire at the end of 2025. So on January 1st, 2026, if Congress doesn't act to extend them, the tax code essentially reverts to where it was before 2018. What does that mean in real dollars? It means the standard deduction goes back down. For a single filer in 2017, the standard deduction was $6,350. For 2024, it's $14,600. That's more than double. If things revert, you're going to lose a huge portion of that deduction. For married couples filing jointly, the 2024 standard deduction is $29,200. If we go back to pre-2018 rules, that number shrinks dramatically. So right away, your taxable income goes up, not because you earned more money, but because the deductions protecting you went away. And then, the tax brackets themselves. Right now, the 22% bracket for a single filer kicks in at about $47,151. Under pre-2018 rules, what used to be a 25% bracket started at a similar income level, so you could be paying 25% instead of 22% on a chunk of your income. That might not sound like a massive difference, but when you're talking about tens of thousands of dollars of RMD income every year for potentially 20 or more years of retirement, those extra percentage points add up to an absolutely staggering amount of money over time. Now let's run a real scenario, because I want this to feel concrete for you. Let's say you're 74 years old in 2026. You have $800,000 in your traditional IRA. Your Social Security benefit is $24,000 a year. You have no pension. Based on the IRS Uniform Lifetime Table, your RMD at age 74 would be approximately $31,000, give or take, depending on your exact balance. So now you've got $24,000 from Social Security and $31,000 from your RMD. That's $55,000 in total income before we even get into how Social Security is taxed. Here's where it gets painful. If your combined income, which the IRS calculates as your adjusted gross income plus half of your Social Security benefits, exceeds $34,000 as a single filer, up to 85% of your Social Security benefits become taxable. So now, up to $20,400 of your Social Security is suddenly sitting in your taxable income column. You're looking at a taxable income potentially above $50,000, and if the 2017 tax cuts have expired, you're hitting that with a smaller standard deduction and a higher marginal rate. The extra tax bill compared to what you might have paid in 2024 under current rules could easily be $3,000 to $6,000 more per year. Every single year, for decades. And remember, your RMD doesn't stay the same. It grows. Every year you get older, the percentage you're required to withdraw increases. And if your account balance also grows, which it very well might if markets perform well, your RMD goes up even faster. Some financial planning researchers have projected that for people with $1 million or more in tax-deferred accounts who start RMDs at 73, their annual RMD by age 85 could easily exceed $70,000 to $80,000. That's a lot of taxable income hitting you every year in your 80s, when your flexibility to work around it is much more limited. Now here's something else that people completely overlook, and I really want to make sure you hear this part clearly. The IRMAA A surcharge. Medicare Part B in 2025 has a standard premium of $185 per month. But if your income from 2 years prior, and yes, Medicare looks back 2 years, exceeded $106,000 as a single filer or $212,000 as a married couple filing jointly, you start paying surcharges. Those surcharges can add anywhere from a few $100s to over $5,000 per year per person on top of your regular Medicare premiums. And what triggers those surcharges? Income. And what's driving your income up right as you enter your 70s and 80s? Your RMDs. This is the silent part of the bomb. It's not just your income tax going up. It's your Medicare premiums going up 2 years later because of a high-income year you may not have even been able to avoid. So now, let me talk about what you can actually do about this, because I don't want this to just be a scare video. I want you to walk away from this with real options that you can take to your financial advisor or start thinking through on your own. The single most powerful tool for dealing with this situation is called a Roth conversion. And if you haven't heard about Roth conversions or haven't taken them seriously, now is the time, because the window is closing. A Roth conversion is when you take money out of a traditional IRA or 401k, pay the taxes on it now at today's rates, and move it into a Roth IRA where it grows tax-free and is never subject to RMDs during your lifetime. The beauty of doing this in 2025 or even partially in 2024, if you're watching this before year end, is that you're doing it while the tax rates from the 2017 Tax Cuts and Jobs Act are still in effect. You're paying taxes at what are likely the lowest rates you'll see for the foreseeable future. Now, I want to be clear here. A Roth conversion isn't a magic bullet, and it's not right for everyone in every situation. If you convert too much in 1 year, you can actually push yourself into a higher bracket right now and trigger IRMAA 2 years down the road. So the strategy is about doing partial conversions thoughtfully over several years, filling up your current tax bracket without going over the threshold into the next one. This is sometimes called bracket filling or bracket management, and it's genuinely one of the most powerful tax planning strategies available to retirees and near retirees today. Let me give you a practical example of what this could look like. Say you're 65 years old, retired, and your taxable income this year is $40,000 between Social Security and some small investment income. For a single filer in 2025, the top of the 22% bracket is around $100,525. That means you have roughly $60,000 of space before you hit the 24% bracket. You could convert $30,000 or $40,000 from your traditional IRA to a Roth this year, pay taxes at 22%, and permanently remove that money from the RMD calculation. Do that for several years between now and when you turn 73, and you could dramatically reduce the size of your taxable accounts and the magnitude of the RMD bomb waiting for you. Another strategy worth knowing about is something called a qualified charitable distribution, or QCD. If you're 70 and a half or older, the IRS allows you to donate up to $105,000 directly from your IRA to a qualified charity. The key word there is directly. The money goes straight from your IRA to the charity without ever touching your hands or your bank account, and it counts towards satisfying your RMD for the year. But here's the beautiful part. It doesn't count as taxable income. So if your RMD is $30,000 and you donate $10,000 through a QCD, only $20,000 shows up on your tax return as income. For people who are already charitably inclined, this is a genuinely incredible tax tool that not enough people are using. And the limit was updated from $100,000 to $105,000 for 2024 as part of the inflation adjustments tied to Secure 2.0. Now, I also want to address something that a lot of people ask me about, which is whether delaying Social Security helps with this situation. The answer is nuanced. Delaying Social Security absolutely increases your eventual benefit. For every year you delay beyond your full retirement age up to age 70, your benefit grows by 8%. That's a guaranteed 8% return, which is remarkable. But the trade-off is that if you're not taking Social Security income during those delay years, you may need to pull more from your taxable accounts to cover living expenses, which could actually accelerate your RMDs or force you to sell assets at, potentially, inopportune times. So, the Social Security delay decision has to be made holistically with your overall income picture in mind, not in isolation. There's also a strategy around when you actually take your first RMD that's worth mentioning. The law allows you to delay your very first RMD until April 1st of the year following the year you turn 73. So if you turn 73 in 2025, you could technically wait until April 1st, 2026 to take that first distribution. Sounds helpful, right? Except here's the catch. If you do that, you have to take 2 RMDs in 2026. One for the 2025 tax year by April 1st, and one for the 2026 tax year by December 31st. 2 distributions in the same calendar year can significantly spike your taxable income and create exactly the kind of tax bracket and IRMAA problems we've been talking about. So in most cases, especially heading into a year where tax rates may be going up, it's smarter to take your first RMD on time in the year you actually turn 73 rather than waiting. I also want to talk about spousal considerations because this comes up constantly in the comments. If you're married and one spouse has significantly larger retirement accounts than the other, the RMD burden can be very lopsided. Both of your incomes get combined on your joint tax return, so a large RMD from one spouse affects the household tax situation equally. Doing partial Roth conversions from the larger account while both spouses are still alive, and especially while the higher earner is still bringing in income that might allow for strategic income planning, can make a huge difference. And in the unfortunate event that one spouse passes away, the surviving spouse shifts from married filing jointly to single filing status, which means their tax bracket's cut in half. A widow or widower who had $800,000 in a traditional IRA suddenly faces their RMDs being taxed at rates that would have applied to twice the income under joint filing. This is sometimes called the widow's penalty, and it's a real and devastating tax hit that catches so many families off guard. Now let me step back for a second and give you the bigger picture of why this matters so much right now specifically. We are in what financial planners are calling a golden window for tax planning, the combination of the 2017 tax cuts still being in effect through the end of 2025, interest rates being where they are, and the coming sunset of those provisions creates a very specific and very time-limited opportunity. If you're between the ages of 60 and 72 right now, you potentially have a window, maybe a few years, maybe just 1 year, to do strategic Roth conversions at rates that may not be available again in your lifetime. And if you're already taking RMDs, the QCD strategy and careful income management can still make a meaningful dent in your tax exposure. I want to be very direct with you here because I think it's important. The people who are going to get hit hardest by the Silent RMD Bomb in 2026 are the people who assume that because things have been fine for the last several years, they'll continue to be fine. They haven't updated their retirement income plan. They haven't run any projections on what happens if tax rates reset. They haven't thought about IRMAA. And they're going to open their tax bill in April 2027 and be genuinely blindsided. I don't want that to be you. Now here's something that I think is really worth sitting with for a moment, and it's a point that doesn't get made often enough. The money in your traditional IRA isn't entirely yours. I know that sounds harsh, but it's the truth. A portion of it belongs to the IRS. They let you defer that tax for decades, and now they want their share. The question isn't whether they're going to get it, they are. The question is whether you get to decide when and how they get it, or whether they force your hand through RMDs at the worst possible time. Taking control of that timing through smart Roth conversion strategies and income planning is one of the most powerful acts of financial autonomy you can exercise in retirement. And this isn't just about the taxes you pay, it's about the legacy you leave. If you have money left in a traditional IRA when you pass away, your heirs inherit it, but they also inherit the tax liability. Under current law, as modified by the Secure Act of 2019 and Secure 2.0, most non-spouse beneficiaries are required to fully distribute an inherited IRA within 10 years. If your adult children are in their peak earning years when they inherit your traditional IRA, they could be pulling out that money at 32%, 35%, or even 37% marginal tax rates. That's money that could have been converted to a Roth at 22% or 24% during your retirement and passed on tax-free. The decision you make today about your retirement account structure is literally a decision about how much of your life savings actually stays in your family versus going to the federal government. Let me also touch on something I know a lot of you are wondering about, which is whether Congress will actually let the tax cuts expire. That's the million-dollar question, and honestly, nobody knows for sure. There has been significant political discussion about extending the provisions, and the current political environment as of early 2025 leans toward some form of extension, or at least partial preservation of the current rates. But here's the thing. Even if rates are extended, there's no guarantee they'll be extended in exactly the same form, or for how long, or whether future legislation might change things again. Relying on Congress to solve your retirement tax problem for you is not a strategy. Taking action based on what the law currently says is the only responsible path forward. You plan for the rules as they are today while you still have time to act. I've spoken with a lot of retirees who say something like, "Well, I'll figure that out when it happens." And I understand that impulse. Retirement is supposed to be a time of rest, not constant financial strategizing. But the math here is really unforgiving. A $5,000 per year tax increase that you could have prevented with proper planning in 2025 turns into $100,000 in extra taxes over a 20-year retirement. That's not a number you can just shrug off. That's a vacation for every year of your retirement. That's grandkids' college tuition. That's years of financial security that get quietly drained away, not by bad investments or market crashes, but by a tax code change that you had time to prepare for, but didn't. And I want to make sure we talk about one more thing before we wrap up, which is the emotional side of this. A lot of people I talk to feel a sense of guilt or anxiety about thinking of ways to reduce their taxes. Like somehow it's not right to try and keep more of your own money. But I want to reframe that for you. Everything we've talked about today, Roth conversions, qualified charitable distributions, strategic income planning, these are all perfectly legal, IRS-approved strategies. The tax code was designed with these options in it. Using them isn't avoiding your responsibility, it's exercising your right. The IRS published those rules. A qualified financial planner, or CPA, can help you implement them. You have every right to structure your retirement income in a way that minimizes your tax burden within the law. That's not cheating. That's planning. The key word there is planning, and specifically planning before the deadline. And the deadline here is real. The end of 2025 is when the Tax Cuts and Jobs Act provisions are scheduled to sunset. Whatever actions you can take this year, whether it's a Roth conversion, updating your income projections, talking to a qualified retirement planner, or simply getting clear on what your RMD is going to look like over the next 10 years, this is the time to do them. Look, I've been making these videos for a while now, and the comments that mean the most to me are the ones from people who say they took action after watching a video here, and it made a real difference in their retirement. That's why I do this. I'm not a financial advisor, I'm not your CPA, and nothing in this video is personalized financial advice. But what this video is a wake-up call, a clear explanation of something real that is heading straight for a lot of retirees who don't see it coming. And if this video helped you see it more clearly, I hope you'll do two things right now. First, drop a comment below and tell me, did you know about the Silent RMD Bomb before watching this video? I genuinely read every comment and I love hearing from this community. Let me know if this is something you've been worried about or something that totally caught you off guard. And if you're already taking steps to prepare for it, share what you're doing, because your experience might be exactly what someone else in this community needs to hear. This is a community of people who look out for each other, and that's something I'm really proud of. Second, if you got real value from this video, please share it. I'm serious about this one. There are people in your life, your spouse, your sibling, your parents, your friends who are in their 60s and 70s, who need to hear this before 2026. They may not be watching retirement content on YouTube. They may not have anyone in their life who's going to bring this to their attention, but you can be that person. Just hit the share button and send this to someone who has money in a traditional IRA or 401k. It takes 2 seconds and it could genuinely save them thousands of dollars. And hey, if you haven't subscribed yet, what are you waiting for? We talk about this kind of stuff every single week on Jason Retires. Real information, real numbers, real strategies for real people who are trying to make the most of their retirement. Hit the subscribe button and the bell notification so you don't miss a single video, because next week I'm going to be covering something equally important that connects directly to what we talked about today, and trust me, you're going to want to be here for that one. The Silent RMD Bomb is real. It's coming. And now you know about it. That puts you ahead of a lot of people. Don't waste that advantage. Take action, stay informed, and I'll see you in the next one.